Hello guys, this is my first video on this YouTube channel and today we are going to talk about trading systems, everything you need to know. Okay, let's start. Trading systems or a trading strategy is the backbone for all types of traders. While money management and risk management plays a major role in determining one's success in trading, without a trading system or a strategy, a trader has nothing else to do but to sit on their hands. Perhaps the importance of trading systems and strategies can be best gauged based on the ecosystem that it has spawned. Today, a trader is not short of choices with a wide range of black box trading systems and strategies available at one's disposal. And browsing through any of the many trading forums, it is not hard to miss the section about trading systems and strategies. Look to any reputable trading magazine and you are bound to find a section related to stock trading systems. It could a simple technical analysis based trading strategy and it can get as complex as using fundamentals. There is a very strong likelihood that a trader will spend most of their time honing their skills on a trading system. It is through this process over evolution that a trader finally catches on a system or a style that works best for them. What is a trading system? A trading system is a set of rules that can be based on technical indicators or fundamental analysis. A trading system tells the trader when and how to trade. In many cases, trading systems act like a blueprint for trading. A trading system is important for a trader because without it there is no way a trader can expect to trade. Despite getting lucky a few times, one cannot expect to remain consistently profitable without following a trading system or a strategy. What are the different types of trading system available? Trading systems can be broadly classified into two types: mechanical trading system and discretionary trading system. Everything else is either a clone of one of the above two. You can have a trading system based on technical indicators, and you can also have a trading system that focuses on the fundamentals. There is no telling which of the above two approaches are better. But it is known for sure that the more familiar a trader is with their trading system, the better their odds at being consistently profitable. What is a mechanical trading system? As the name suggests, a mechanical trading system is based on a set of trading rules. The trading rules are developed when several technical or fundamental indicators trigger a buy or a sell. A mechanical trading system is the easiest to automate as there is not much of discretion involved. A buy or a sell trade is initiated when the trading conditions are met. An example of a mechanical trading system could be something as simple as a moving average crossover. Now, now instead of having to wait for the 50 and 200-day moving average to trigger a bullish or a bearish crossover to buy or sell, a trader can simply code these rules into an algorithm which will constantly monitor the markets. As and when the trading conditions are met, the appropriate trade is taken. What makes now let's going about another pros and cons of a mechanical trading system. A mechanical trading system is good when the rules are very clear and leaves no room for any discretion. It can be easily coded or programmed. It can be easily back tested to check the past performance of the trading system. Traders can view the back testing and forward testing data to further fine tune the trading system. A mechanical trading system leaves out any room for emotions and is purely based on logic. There is no need for human interference for a mechanical trading system. A mechanical trading system is not always ideal in conditions such as uncertain markets where fundamentals can cut the trading system's ability to trade. Using too complex or custom indicators of trading rules, coding or programming errors, curve fitting the trading system to show favorable results on past performance. What is a discretionary trading system? A discretionary trading system is where the traders are based on a mix of trading rules and experience. In some cases, discretionary trading systems can easily trump mechanical trading systems. The discretionary trading system is comparatively complex than a rule-based trading system. It can be difficult to code a discretionary trading system as the buy and sell rules can change at every instance. Thus, there is no uniformity involved, and the success of using a discretionary trading system largely depends on the trader's familiarity with the system. The auto trading system. The auto trading system is no doubt one of the most popular ways to day trade. It can be particularly beneficial in certain markets such as futures, which allows you trade on leverage with low margin requirements. Since the market is nothing more than the emotional sum of its participants, an auto trading system will allow a trader to separate themselves from the noise and emotions. Let's talk about reviewing a trading system. Whether it is a discretionary or a mechanical trading system being used, one must thoroughly examine the strategy. Presently, there are many solutions that offer to analyze your trading systems for you, giving you a detailed report on the pros and cons. This is a huge time saver compared to having to analyze the trading systems all by yourself. It is ultimately up to the individual investor to perform his or her due diligence on the trading system that they want to use. The key thing to remember is to not only focus on the gains over a, a specified period of time, but also the maximum drawdown and risks exposure of the system. For example, if a trading system that trades during a bear market is making a lot of profits when the markets are falling, it doesn't mean much. The trading system should also be tested during a market uptrend as well. So guys, we will end on this. Goodbye. Hello guys, this video about cryptocurrencies, the top things you need to know. Okay, let's start. Bitcoin and other cryptocurrencies are splashed across news headlines on a regular basis, charting a wild ride of extreme highs and lows. Once the sole domain of anti-establishment millennials burned by the 2008 recession, many institutional investors have shed their skepticism and are dipping their toes into the crypto market, adding exposure through crypto funds, futures, and other emerging investment options. However, the world of crypto investing is still relatively uncharted territory. It is important to understand what cryptocurrencies are before investing or accounting for them. Organizations that take a step-by-step approach to due diligence and gain experience with small, low-risk projects involving cryptocurrencies may find they present exciting new opportunities. What is cryptocurrency? Cryptocurrency is a type of digital asset that is an intangible digital currency that uses a highly sophisticated type of encryption called cryptography to secure and verify transactions, as well as to control the creation of new units of currency. It is designed to work as a decentralized medium of exchange, independent of a financial institution or any other central authority. While Bitcoin is the most well-known cryptocurrency, it is not the only one. Other major types of cryptocurrencies include Ethereum, Ripple, Bitcoin Cash, and Litecoin. There are also other digital assets or crypto assets. These are commonly referred to as digital tokens. For example, a company can initiate a token sale or a token launch, which is otherwise frequently referred to as an initial coin offering. In an initial coin offering, a company is creating a new product and wants to build a user base who will benefit from purchasing the product early. The ICO also enables the company to raise proceeds to develop the product. It is attractive to companies because they can bypass the rigorous and regulated capital raising process required by uh, venture capitalists or banks. While this FAQ does not further explore ICOs or tokens, initiates and are encouraged to consult with their legal, accounting, and tax advisors given the complexities and significant debate by regulators around such digital assets. What is Bitcoin? While there have been several attempts to create cryptocurrencies since the 1990s tech boom, Bitcoin is the first to gain widespread public notoriety. Leveraging open source peer-to-peer technology, the transaction and issuance of Bitcoin is collectively managed by the network, effectively cutting out the middleman. Introduced by an anonymous programmer or group of programmers under the alias Satoshi Nakamoto. Bitcoin has consistently dominated the crypto market since it became available to the public in 2009. It has remained relatively unchallenged until the introduction of the Ethereum platform in 2016. Cryptocurrencies, including Bitcoin and Ethereum, are more volatile than traditional fiat currencies. Fiat currencies are declared to be legal tender by a government and are not backed by physical commodities. What is blockchain and how is it connected to currency? Blockchain technology is a type of distributed ledger technology (DLT) that facilitates peer-to-peer transactions in a secure and verifiable way without a centralized party. It is a single, incorruptible database that continuously records and timestamps transactions or blocks chronologically. Every transaction must be verified through a process known as consensus, requiring multiple system participants to independently verify authenticity of the output of the algorithm creating the block. Once a new entry has been agreed to, verified, and made in the blockchain, it is locked, meaning it cannot be modified. It can only be updated by adding a new entry as an addendum. The best known use of blockchain to date is to support the transactions of cryptocurrencies such as Bitcoin, and while the two are often conjoined, are confused, Bitcoin is just one of many potential blockchain applications. Bitcoin is in essence a form of currency, Blockchain is a database that enables its unique secure transaction. How are cryptocurrencies created? The process of creating a new type of cryptocurrency coins requires either building a new blockchain or modifying an existing process to create a new variant of or fork. The majority of these so-called altcoins are forks of the Bitcoin protocol. The only way more coins of an existing crypto coin can be created is through a process called mining, in which the miner is awarded a transactions fee, a new coin, in exchange for contributing to the underlying blockchain algorithm by being the first to solve a cryptographic puzzle. Mining is extremely competitive and requires significant computing power. Some cryptocurrencies, like Bitcoin, are finite in supply, meaning that there is a maximum number of coins that will ever be in circulation. Others do not have a maximum cap but limit the number of new coins that can be generated each year. So, guys, we will end on this. Goodbye. Hello guys, this video about automated trading systems, the pros and cons. Okay, let's start. What is an automated trading system? Automated trading systems, also referred to as mechanical trading systems, algorithmic trading, automated trading or system trading, allow traders to establish specific rules for both trade entires and exists that once programmed can be automatically executed via a computer. In fact, various platforms report 70% to 80% or more of shares traded on US stock exchanges come from automatic trading systems. Traders and investors can turn precise entry, exit, and money management rules into automated trading systems that allow computers to execute and monitor the trades. One of the biggest attractions of strategy automation is that it can take some of the emotion out of since trades are automatically placed once certain criteria are met. The trade entry and exit rules can be based on simple conditions such as moving average crossover, or they can be complicated strategies that require a comprehensive understanding of the programming language specific to the user's trading platform. They can also be based on the expertise of a qualified programmer. Automated trading systems typically require the use of software linked to a direct access broker, and any specific rules must be written in that platform's proprietary language. The TradeStation platform, for example, uses the Easy Language programming language. On the other hand, the NinjaTrader platform utilizes NinjaScript. The figure below shows an example of an automated trading strategy that triggered 3 trades during a trading season. Oh my. Establishing trading rules. Some trading platforms have strategy building wizards that allow users to make selections from a list of commonly available technical indicators to build a set of rules that can then be automatically traded. The user could establish, for example, that a long position trade will be entered once the 50-day moving average crosses above the 200-day moving average on a 5-minute chart of a particular trading instrument. Users can also input the type of order, market or limit for instance, and when the trade will be triggered, for example at the close of the bar or open of the next bar, or use the platform's default inputs. Many traders, however, choose to program their own custom indicators and strategies. They will often work closely with the programmer to develop the system. While this typically requires more effort than using the platform's wizard, it allows a much greater degree of flexibility and the results can be more rewarding. Just like anything else in the trading world, there is unfortunately no perfect investment strategy that will guarantee success. Once the rules have been established, the computer can monitor the markets to find buy or sell opportunities based on the trading strategies specifications. Depending on the specific rules, as soon as a trade is entered and any orders for protective stop losses, trailing stops, and profit targets will be automatically generated. In fast moving markets, this instantaneous order entry can mean the difference between a small loss and a catastrophic loss in the event the trade moves against the trader. Uh, advantages or advantages of automated systems. There is a long list of advantages to having a computer monitor the markets for trading opportunities and execute the traders, including minimizing emotions. Automated trading systems minimize emotions throughout the trading process by keeping emotions in check. Traders typically have an easier time sticking to the plan. Since trade orders are executed automatically once the trade rules have been met, traders will not be able to uh, hesitate or question the trade. In addition to helping traders who are afraid to pull the trigger, automated trading can curb those who are apt to overtrade, buying and selling at every perceived opportunity. Backtesting. Backtesting applies trading rules to historical market data to determine the viability of the idea. When designing a system for automated trading, all rules need to be absolute, with no room for interpretation. The computer cannot make guesses, and it has to be told exactly what to do. Traders can take these precise sets of rules and test them on historical data before risking money in live trading. Careful backtesting allows traders to evaluate and fine-tune a trading idea and to determine the system's uh, expectancy. The average amount a trader can expect to win or lose per unit of risk. Um, Last, what I want to say, this is drawbacks of automated systems. Automated trading systems boast many advantages, but there are some downfalls and realities traders should be aware of. Okay, we will end this video on this material. Push likes and subscribe. Hello guys, this video about Ethereum basics. What is Ethereum? Okay, let's start. Ethereum itself is not a cryptocurrency, but rather a programmable platform that built using blockchain technology. Its native token used to fuel operations on the blockchain is the other Ethereum. The Ethereum platform launched in 2015 and it's now the second largest form of crypto next to Bitcoin, with a market capitalization of about $533 billion as of December 2021. Keep reading to understand how Ethereum works, how it's different than Bitcoin, and how to invest in Ethereum. How does Ethereum work? The concept for the Ethereum platform was first proposed in a white paper by Vitalik Buterin in 2013. In 2014, he and a team of developers raised about $18 million to establish the non-profit Ethereum Foundation and fund its development. The Ethereum platform launched a year later in 2015. From the beginning, the vision for the Ethereum was quite different from Bitcoin or any other cryptocurrency at the time. Like Bitcoin, Ethereum is built on a blockchain and uses blockchain technology to run a decentralized payment system for Ethereum. But the larger idea for Ethereum was to create a programmable blockchain that would enable a sort of free market environment where developers could create applications and programs without any control or interference from a third party. How the Ethereum blockchain works. The Ethereum blockchain operates similar to the Bitcoin blockchain. It's a distributed digital ledger that is maintained by a global network of nodes or computers that verify all transactions on the blockchain. The Ethereum blockchain also supports the mining of Ether, Ethereum's native token, which is mined using a proof of work system. In proof of work mining, computers burn energy to solve complex mathematical puzzles needed to validate blocks of data or transactions. Miners batch transactions into new blocks uh, roughly every 12 seconds versus the 8 or 9 minutes it takes to confirm blocks of data on the Bitcoin blockchain. On the Ethereum blockchain, users can create and store code used to build decentralized applications and financial contracts, an innovation that has set Ethereum apart from Bitcoin and inspired other crypto platforms to attempt similar innovations. Smart contracts and DeFi. Developers write programs in the project main programming languages, Solidity or Viper, and then deploy this code on the Ethereum blockchain. All nodes maintain a copy of the Ethereum virtual machine, which translates the smart contracts and executes their changes in transactions on the blockchain. Those smart contracts are self-executing and don't need a third party to be effective. The development of these smart contracts is part of what has fueled the growth of decentralized finance or DeFi, with the Ethereum platform being a leading innovator in this new area. Ethereum and ICOs. The flexibility and adaptability of the Ethereum blockchain has also allowed it to support the development of new forms of crypto based on the Ethereum source code. Thus, the Ethereum platform became foundational for several initial coin offerings or ICOs. What is Ether? Ether can be thought of as both a type of cryptocurrency that can be bought and sold and as the transactional currency that helps drive various operations on the Ethereum platform. Ether as crypto. Ether is the second largest type of cryptocurrency. You can buy and sell Ether on crypto exchanges and other platforms that support crypto trading. How Ether is used on Ethereum. Like other cryptocurrencies, Ether is a medium of exchange, but Ether tokens can only be used on the Ethereum network. That's because Ether are designed to support the development of decentralized applications on the Ethereum platform. Users can trade other crypto for Ether tokens, or they can use a fiat currency like the dollar to buy Ether. But you cannot substitute another type of crypto for Ether in order to provide computing power for Ethereum transactions. What is gas versus Ether? Gas refers to the computational power required to complete various tasks on the platform. It's essentially a unit of measurement. To pay for gas, developers can use fractions of Ether tokens, sometimes called GUI. So guys, let's maybe talk about Bitcoin versus Ethereum. Bitcoin and Ether are both digital currencies, but Bitcoin was established as an alternative currency, whereas the aim of Ethereum is to monetize the operation of smart contracts and decentralized applications on the Ethereum platform. Bitcoin is also limited. The number of bitcoins that can be mined is capped at 21 million. The number of Ethereum is unlimited, but the amount is capped at 18 million per year, as noted above. We will end on this. Goodbye. Hello guys, let's talk about 10-day trading strategies for beginners. Day trading is the act of buying and selling a financial instrument within the same day or even multiply times over the course of a day. Taking advantage of small price moves can be a lucrative game if it is played correctly, but it can be a dangerous game for newbies or anyone who doesn't adhere to a well thought out strategy. Not all brokers are suited for the high volume of trades made by day traders, however, but some brokers are designed with the day trader in mind. You can check out our list of the best brokers for day trading to see which brokers best accommodate those who would like to day trade. The online brokers on our list, Fidelity and Interactive brokers, have professional or advanced versions of their platforms that feature real-time streaming quotes, advanced charting tools, and the ability to enter and modify complex orders in quick succession. First of all, it is knowledge is power. In addition to knowledge of basic trading procedures, day traders need to keep up on the latest stock market news and events that affect stocks, the Fed's interest rate plans, the economic outlook, etc. So do your homework. Make a wish list of stocks you would like to trade and keep yourself informed about the listed companies and general markets. Scan business news, scan business news, and visit reliable financial websites. 2. Set aside funds. Assess how much capital you're willing to risk on each trade. Many successful day traders risk less than 1% to 2% of their accounts per trade. If you have a $40,000 trading account and are willing to risk 0.5% of your capital on each trade, your maximum loss per trade is $200. Set aside a surplus amount of funds you can trade with and are prepared to lose. Remember, it may or may not happen. 3. Set aside time to Day trading requires your time. That's why it's called day trading. You will need to give up most of your day. In fact, don't consider it if you have limited time to spare. The process requires a trader to track the markets and spot opportunities which can arise at any time during trading hours. Moving quickly is key. 4. Start small. As a beginner, focus on a maximum of 1 to 2 stocks during a session. Tracking and finding opportunities is easier with just a few stocks. Recently, it has become increasingly common to be able to trade fractional shares, so you can specify specific smaller dollar amounts you wish to invest. That means if Amazon shares are trading at $3,400, many brokers will now let you purchase a fractional share for an amount that can be as low as $25 or less than 1% of a full Amazon share. 5. Avoid penny stocks. You are probably looking for deals and low prices, but stay away from penny stocks. These stocks are often illiquid and chances of hitting a jackpot are often bleak. Many stocks trading under $5 a share become delisted from major stock exchanges and are only tradable over the counter. Unless you see a real opportunity and have done your research, stay clear of this. 6. Time those trades. Many orders placed by investors and traders begin to execute as soon as the markets open in the morning, which contributes to price volatility. A seasoned player may be able to recognize patterns and pick appropriately to make profits. But for newbies, it may be better just to read the market without making any moves for the first 15 to 20 minutes. The middle hours are usually less volatile, and then movement begins to pick up again toward the closing bell. So the rush hours over opportunities, it's safer for beginners to avoid them at first. 7. Cut losses with limit orders. Decide what type of orders you will use to enter and exit trades. Will you use market orders or limit orders? When you place a market order, it's executed at the best price available at the time. Thus, no price guarantee. A limit order, meanwhile, guarantees the price but not the execution. Limit orders help you trade with more precision, wherein you set your price for buying as well as selling. More sophisticated and experienced day traders may employ the use of options strategies to hedge their position as well. 8. Be realistic about profits. A strategy doesn't need to win all the time to be profitable. Many traders only win 50 to 60% of their trades. However, they make more on their winners than they lose on their losers. Make sure the risk on each trade is limited to a specific percentage of the account, and that entry and exit methods are clearly defined and written down. 9. Stay cool. There are times when the stock markets test your nerves. As a day trader, you need to learn to keep greed, hope, and fear at bay. Decisions should be governed by logic and not emotion. 10. Stick to the plan. Successful traders have to move fast, but they don't have to think fast. Why? Because they've developed a trading strategy in advance, along with the discipline to stick to that strategy. It is important to follow your formula closely rather than try to chase profits. Don't let your emotions get the best of you and make you abandon your strategy. There is a mantra among day traders: plan your trade and trade your plan. Before we go into some of the ins and outs of day trading, let's look at some of the reasons why day trading can be so difficult. We will end on this information. Goodbye. This is a second part of video 10 day trading strategies for beginners. Okay, let's continue. What makes day trading difficult? Day trading takes a lot of practice and know-how, and there are several factors that can make the process challenging. First, know that you are going up against professionals whose careers revolve around trading. These people have access to the best technology and connections in the industry. So even if they fail, they are set up to succeed in the end. If you jump on the bandwagon, it means more profits for them. Uncle Sam will also want a cut of your profits, no matter how slim. Remember that you will have to pay taxes on any short-term gains or any investments you hold for 1 year or less at the marginal rate. The one caveat is that your losses will offset any gains. As an individual investor, you may be prone to emotional and psychological biases. Professional traders are usually able to cut this out of their trading strategies, but when it's your own capital involved, it tends to be a different story. Deciding what and when to buy. Day traders try to make money by exploiting minute price movements in individual assets. stocks, currencies, futures, and options. Usually, leveraging large amounts of capital to do so. In deciding what to focus on in a stock, say a typical day trader looks for three things. One, uh, liquidity. Liquidity allows you to enter and exit a stock at a good price. For instance, tight spreads or the difference between the bid and ask price of a stock, and low slippage or the difference between the expected price of a trade and the actual price. 2. Volatility is simply a measure of the expected daily price range, the range in which a day trader operates. More volatility means greater profit or loss. Trading volume is a measure of how many times a stock is bought and sold in a given time period, most commonly known as the average daily trading volume. A high degree of volume indicates a lot of interest in a stock. An increase in a stock's volume is often a harbinger of a price jump, either up or down. When you know what kind of stocks you are looking for, you need to learn how to identify entry points. That is, at what precise moment you are going to invest. Tools that can help you do this include real-time news services. News moves stocks, so it is important to subscribe to services that tell you when potentially market moving news breaks. ECN level 2 quotes. ECNs or electronic communication networks are computer-based systems that display the best available bid and ask quotes from multiply market participants and then automatically match and execute orders. Level 2 is a subscription based service that provides real time access to the Nasdaq order book composed of price quotes from market makers. Registering every Nasdaq listened and OTC bulletin board security. Together they can give you a sense of orders executed in real time. Define and write down the conditions under which you will enter a position. Buy during uptrend isn't specific enough. Something like this is much more specific and also testable by when price breaks above the upper trend line of a triangle pattern, wherein the triangle was preceded by an uptrend. On the 2-minute chart in the first 2 hours of the trading day. When you have a specific set of entry rules, scan through more charts to see if those conditions are generated each day, and more often than not produce a price move in the anticipated direction. If so, you have a potential entry point for a strategy. You will then need to assess how to exit or sell those trades. Day trading charts and patterns. To help determine the most opportune moment to buy a stock, many traders uh, utilize uh, can candlestick patterns, including engulfing candles and dodges, technical analysis, including trend lines and triangles, volume increasing or decreasing. Uh, Typically look for a pattern like this with several confirmations. 1. First, look for a volume spike which will show you whether traders are supporting the price at this level. Note, this can be either on the doji candle or on the candles immediately following it. Basic day trading strategies. When you have mastered some of these technique-wise and developed your own personal trading styles and determined what your end goals are, you can use a series of strategies to help you in your quest for profits. Here are some popular technique-wise you can see. Also, some of these have been mentioned above, they are worth going into again. Following the trend. Anyone who follows the trend will buy when prices are rising or short sell when they drop. This is done on the assumption that prices that have been rising or falling steadily will continue to do so. Contrarian investing. This strategy assumes the rise in prices will reverse and drop. The contrarian buys during the fall or short sells during the rise with the expectation that the trend will change. Scalping. This is a style by which a speculator exploits small price gaps created by the bid-ask spread. This technique normally involves entering and exiting a position quickly, within minutes or even seconds. Trading the news. Investors using this strategy will buy when good news is announced or short sell when there is bad news. This can lead to greater volatility, which can lead to higher profits or losses. So guys, we end this video. Goodbye.